Thank you for joining us for today's webinar, Low-Income Housing Tax Credit, Management and Compliance. Our speaker for today is Elizabeth Bramlet of Liz Bramlet Consulting LLC. Having worked in the development and compliance components of many housing programs, Liz consults with developers, syndicators, and property managers to create strategies that maximize the value of their property's tax credit allocation. Liz is a nationally recognized expert in the field of affordable housing. She speaks regularly at conferences sponsored by the National Council of State Housing Agencies and to individual state housing finance agencies to share her expertise of the Low-Income Housing Tax Credit Program and other programs that support affordable housing. Thank you, Liz.
Thank you very much, Shantaria. I'm very happy to be with all of you today, even if we're not in the same room together. We've got a lot of material we're going to try to cover in an hour, so let's go ahead and get started. As Shantaria said, what we're going to focus on in this hour today is compliance in the Low-Income Housing Tax Credit Program. And I always say establish and maintaining compliance because in the tax credit program, the first year of the credit period is the critical year for all projects, for all buildings. So first we're going to talk about how you establish compliance during that critical first year, and then we'll talk about how you maintain compliance through the 15-year compliance period. All righty, year one, establishing compliance. We want to start with our placed in service dates. Now, a placed in service date, the general definition is it has the potential to produce a tax credit, which means it's a viable housing opportunity. So a qualified resident could move into the unit and start producing a tax credit for you. Once a unit has been in service a full calendar month, which is what you want to remember, it can begin producing a tax credit once it's occupied by a qualified resident. The tenant income certification that you complete that qualifies the resident, that's what actually turns on the credit stream for your investors. We've got an example here. We're talking about a unit. It can begin producing a credit for you in April if it was placed in service on March 31st and occupied by a qualified resident by the end of April. If you place it in service on April 1st, and you get a qualified resident in there by the end of April, it can produce a credit for you in April. But if that placed in service date slips one day to April 2nd, that unit won't begin to produce a credit for you until May, and then again only if it's occupied by a tenant you've qualified for the program by the end of May. Now typically, all the units in the same building have the same placed in service date. And usually each building has its own placed in service date, its own distinct placed in service date. So if you've got a 3-building project, each of those 3 buildings has its own placed in service date. Now all those 3 buildings could have the same placed in service date, nothing wrong at all with that. That's the way your construction ends up. But each building has its own distinct placed in service date. And why this is so important is because this is the date that your state housing finance agency begins monitoring you for compliance with the tax credit program. I think of it as the day that the development team passes the project over to the management team. And because this is the date from which they're going to begin monitoring you, that's the date from which you have to begin keeping the records that are required by the IRS and your state housing finance agency within the tax credit program. Every owner who applies for an allocation of low-income housing tax credits has to apply for a minimum set-aside. And you have 2 options. You can commit to what's referred to as the 20 at 50, where you commit to renting at least 20% of the units at your project to residents with income no greater than 50% of the area median income. Or you can commit to the 40 at 60, where you promise that you will rent at least 40% of the units at your project. For residents with income at or below 60% of the area median income. Now, this minimum set-aside, it establishes the minimum number of tax credit units you need in your project in order to be part of the program. If you do not at least hit your minimum set-aside, you do not produce a tax credit at all. It also establishes the income limit you will need to use to qualify your applicants if you want their units to produce a federal tax credit. So your income limit from the federal perspective is going to be either 60% of the AMI or 50% of the AMI, depending upon which minimum set-aside your owner committed to. Once an owner commits to a minimum set-aside, it is irrevocable. They put it in their tax credit application to begin with, and then at the end of the allocation process, at the end of the development process, they have to fill out a Form 8609, and that has to be submitted to the IRS for your investors to be able to take their tax credits. And they officially and formally commit to their minimum set-aside under Question 10 on their 8609 form. And once they've made that commitment, that is an irrevocable commitment. You have to meet the requirements of the minimum set-aside by the end of the first year of the credit period if you want to start producing credits, and then you need to at least maintain compliance with that minimum set-aside throughout the compliance period. If you fall out of compliance with your minimum set-aside, the buildings included in your project stop producing their tax credits. I've mentioned the credit period several times. Let's talk about our credit period, compliance, and extended use periods. You must meet the requirements of your minimum set-aside, like we said, by the end of the first year of the credit period and remain in compliance throughout the compliance period. An owner cannot begin a building's credit period because, by the way, that credits are calculated not by project but by building. So if you've got a 3-building project, you calculate the credits separately for each of the 3 buildings. And none of those buildings can produce any size tax credit unless the project as a whole is in compliance with its minimum set-aside. Now, a building's credit period, and this is a building-by-building determination, a building's credit period lasts for 10 years. So your investors want to take all their credits that the building produces for them over this 10-year credit period. And typically that 10 years begins the same year you place the building in service, but you have the option to elect to begin the credit period the following year, the year after the placed in service date. Now, an owner must comply with all federal requirements for the tax credit program for 15 years. So you have a 10-year credit period, but management needs to understand that you have a 15-year compliance period. You get to take your credits over a 10-year credit period, but it takes you 15 years to actually earn those credits. So when you're setting up your management program for a property, you want to make sure you're planning that for at least 15 years. You need to know how to comply with all the requirements of the Low-Income Housing Tax Credit Program. And I have a question here. Are there particular issues around building-by-building determinations if the tax credit project involved scattered sites? That's a very good question. You'll have to, when you plan a scattered site project, you need to make sure it based on how the land is located and how the buildings are located, can they be part of the same project based on where they are located? And if you go to the IRS site and you bring up the 8609 form, and by the way, the IRS site is very user-friendly, mysteriously enough, and there are instructions that go along with filling out that 8609. And it gives you instructions for how to fill out line 8B on that 8609 form, and that's where you define your project. That's where you tell the IRS what buildings you're including in the same project, and that's a really key thing to understand once you really get into all of this. And the instructions for filling out line 8B tell an owner about how they are and are not allowed to combine buildings within the same project. For example, if you are a scattered site project, they can only be included in the same project if it's going to be a 100% tax credit project. On the other hand, if it's going to be mixed income, you've got scattered sites and they're going to be mixed income, they cannot all be included in the same project. And again, you want to read those instructions for how to fill out line 8B, which will tell you how you know if buildings can be included or not be included in the same site. Okay. Now, we were saying this compliance period lasts for 15 years. So if, for example, you mess up in year 12, you are jeopardizing your ownership, your investors having to give back credits that they've taken all the way back to the first year of the credit period, because hopefully by year 12 they've been able to take all of their credits, but now since you have fallen out of compliance, they will have to give back some of those credits to the IRS because of the non-compliance. So one mistake I see is people think that since they're done with the 10-year credit period, they don't have to worry about compliance. That's just not the case. We also have this thing called the extended use period. And it begins year 1 of the credit and compliance period and lasts at least 15 additional years beyond the close of the 15-year compliance period. Now, what you do or don't do during years 1 through 15 is what produces or fails to produce your low-income housing tax credits. But in exchange for receiving an allocation, all owners are required to sign an extended use agreement that has to be recorded in the public record where they commit to operating the property as an affordable property under some scheme for at least 15 additional years. And your compliance requirements might be looser in years 16 and later than they were in years 1 through 15. But you've made a commitment that this will still be an affordable housing opportunity for the low-income residents of your community. All righty, let's talk about the credit allocation and the applicable fraction. Very important to understand. Now, in most tax credit projects, we've already said tax credits are allocated by building. So they're produced by building, they're calculated by building. And each building has its own building identification number, also referred to as a BIN or a BIN number. And as the property manager, when you're setting up your management program, you need to know for each building how much of that building is planned to produce a tax credit for the owners, for the investors. Because it is your goal as the property manager that the percentage of each building that's occupied by tax credit qualified residents be at least equal to the size of that credit allocation. If you are planning and managing a 100% tax credit project, then that means your credit allocation covers all the units and all the buildings in your project. So that means you would want all of your units rented to tax credit qualified residents, because that's the way you can produce the maximum possible tax credit at your project, and that way draw in the maximum possible equity contributions from your investors. Other times you do mixed income projects where you're only partially affordable or partially low income, and we will talk about how those work. First of all, we need to understand this thing called the applicable fraction. And all that is that portion of a building, and it is calculated by building, occupied by tax credit qualified residents. And again, that applicable fraction, since it's calculated by building, it's calculated by BIN. And it's always owner's goal, so it's always the manager's goal to maximize a building's tax credit potential. So you always want to hit the targeted applicable fraction for each building so that it will produce not the minimum possible tax credit, but the maximum possible tax credit. That's what your goal always is. and the applicable fraction is always the lesser of, every time it's calculated, keep in mind, it is always the lesser of the percentage of units in a building versus the percentage of floor space in a building occupied by tax credit qualified residents. So we have an example here. We've got a single building 100-unit project where the owner committed to the 20 at 50 minimum set aside. They got a credit allocation covering 70% of the building. So they need at least 20 tax credit units to meet their minimum set aside and really be in the program. But what they really want are 70 tax credit units rented by the end of the first year of the credit period, because that's what they need to do to maximize their tax credit potential. So we need a 70% applicable fraction. So that means we need 70% of the units and 70% of the floor space occupied by tax credit qualified residents. So you need not only to have the right number of units, but the right combination of units rented to qualified residents so the unit will produce the tax credit your owners are counting on. So this building had 100 units, and we're saying that it covers 80,000 square feet. So to hit a 70% applicable fraction, we need at least 70 tax credit units, and those 70 units need to take up at least 56,000 square feet. That way both your unit applicable fraction and your floor space fraction will be at least 70%. So you can see, particularly when you're doing mixed income projects, you really need to map out that lease up so you can know for sure you are renting the right combination of units to low-income families so that you will produce the tax credit you are counting on. Now, you must calculate a building's applicable fraction at the end of each year of the compliance period, because what you are required to do in order to get your maximum credits is to hit your applicable fraction by the end of year one, and then you have to maintain that applicable fraction throughout the 15-year compliance period. So that means when property management is making their leasing and occupancy decisions during that 15-year compliance period, those decisions are always made towards the goal of maintaining that applicable fraction that you hopefully hit by the end of the first year of the credit period. Any other questions anybody would like to ask before we move on? All right then, let's talk about year one of the credit period. Year one of the credit period is the critical year for every tax credit building. When you lease each unit during the first year of the credit period, meaning when you qualify it, and a unit becomes qualified when it's occupied by a qualified resident. When that happens, how quickly you lease up, it sets the value of your credits for the first year of the credit period and the potential value of the credits for the entire credit and compliance periods. There are two rules you want to understand about year one that we're going to talk about right now. The first one we refer to as the first year averaging convention. A building produces a tax credit for the first year of the credit period based on the applicable fraction you calculate as of 12/31 of that year. So that's the reason we say you always want to get everything leased up by 12/31, because that's when that applicable fraction is calculated for year one. But also during year one, and only during year one of the credit period, you have to calculate a building's applicable fraction on a monthly basis. So on a monthly basis, during year one, you have to track how much of that building was qualified to produce a tax credit. And that is because the owner must split the tax credit the building produces for year one between their tax return for year one and their tax return for year 11. So we have to calculate that average applicable fraction so we know how that first year's credit is going to be split. The portion of the first year's tax credit the owner may take on their first year's tax return is calculated using that average applicable fraction for the months included in year one. All right, so we need the average applicable fraction to calculate the credit your investors will really get to take on their year one tax returns. The portion of the first year's credit they are unable to take on their year one tax return, they get to take on their year 11 tax return, or as it is often referred to, on the back end. Here we've got an example of 50-unit, 100% tax credit building placed in service July 15, 2011. They didn't place in service until July, and it was mid-July, so they really won't be able to have an applicable fraction until August, because remember, you have to be in service a full calendar month. So the applicable fraction for the months January through July is 0%. They hit 20% by the end of August, 40% leased up by the end of September, 80% by the end of October, and then they hit their goal of 100% by November and maintain it through December. So their first year applicable fraction is what they want it to be, 100%. But we need to figure the average applicable fraction for the year. So we add up all those applicable fractions for the months, and yes, we have to divide by 12 months, even though we have not been in service for 12 months. So we do that division, and we get an average applicable fraction for the year of 28.33%. Now, we're estimating that the annual tax credit that the building will produce is $450,000. So they can take 28.33% of it on their year one tax return, so that's going to be a little more than $127,000, and they have to leave the rest of the $450,000 credit to take on their year 11 tax return. So they have to leave $322,000 plus to take on their year 11 tax return. So you can see here there's a real incentive for management to get these units qualified, meaning occupied with qualified tenants, as quickly as possible, because the quicker you lease up your units, the quicker you qualify your residents, the bigger your tax credit the investors can actually take on their year one tax return, and then that helps to maximize how much equity they will contribute to the project. The other rule for year one that we want to make sure everybody in management understands is this thing called the 2/3 rule. If you don't meet your targeted applicable fraction, if you don't get your lease up done by the end of the first year of the credit period, you should still try to reach your goal. You still should go on in year two trying to lease up the rest of your projected low-income units. However, units that are first rented to tax credit qualified residents after the first year of the credit period generate 2/3 the annual credit they would have produced if they had first been rented during year one. So a unit not rented to a qualified resident during year one doesn't produce any credit at all for year one, and when it does start producing a credit, because you've got a qualified resident in, its annual credit is 2/3 the size you really wanted it to be. So in this example, we've got a small building. A building allocated 9 tax credit units, and we're projecting that each will generate a $6,000 annual credit, but that's only if it's rented during year one. So we're looking at a total credit annually for the building of $54,000. Multiply that times 10 years, the 10-year credit period, we're talking about a total credit produced, hopefully, of $540,000. But we ran into some leasing and occupancy issues, and we only got 6 units rented during year one, and the other 3 units we got rented during year 2. So those 6 units will begin to produce a credit in year 1, but that means we're going to have a year 1 tax credit. Excuse me, I hit the button. I didn't mean to. Let me go back. Alrighty. Those 6 units will produce a credit in year 1, but that will only produce an annual credit for year 1 of $36,000. And remember, we were shooting for $54,000. And then we get those other 3 units rented during year 2, but they will only produce a $4,000 annual credit because they are under the 2/3 rule. So we run that math, and that gives us a credit for year 2 of $48,000. And that's now what we can produce in years 2 through 10, because those 3 units will always only produce an annual credit of $4,000 because they weren't qualified during year 1. So the building will produce an annual credit of the $48,000 years 2 through 10. Those 3 units that did not get rented until year 2, they can continue producing their $4,000 annual credits 11 through 15. So another thing you'll hear, units that fall under the 2/3 rule, sometimes you'll hear them referred to as 15-year credits, because the owner is required to stretch the credits out over 15 years instead of getting to take them over 10. So we run the math, and we see that the total credit this building will produce now is $528,000. And remember, we were shooting for $540,000. So that means the investor will put less into the project because their total credit is smaller, and some of the credits are going to flow to them slower than projected, so they will be less valuable to them. Now, it's important that you understand the partnership agreement. It governs the relationship between the developer and the investors. And often the investor is represented by a syndicator whose job it is to go out and find the investors, and then they look out for the interest of the investors. And that partnership agreement, it establishes the conditions under which the investor puts money into the project. So it details how much less they'll put into the project should there be a smaller tax credit or a slower credit stream. And it will be spelled out in the partnership agreement how the developer has to compensate the investor if the credits are not produced as projected in the partnership agreement, because that partnership agreement is all about protecting the rate of return for the investors. And what management needs to understand is sometimes in the management agreement between the developer and the management company, it will say that the management company has to make the developer whole when there has been a loss of credits and it is shown to be the fault of the management company. So everybody has a financial stake here in maintaining compliance at these low-income housing tax credit properties. Now, your state housing finance agency carries the responsibility of monitoring your projects for compliance. And they have to come out the first time within 2 years of you placing a project's last building into service, and then they have to come out again at least every 3 years. And every time they come, they must inspect at least 20% of your units and your resident files. And they notify you if they find an incidence, pardon that typo there, I've got incident, an incidence I meant to say, of noncompliance. Now, when they come and they look at your tenant files, they will always review the initial tenant income certification for that tenant and its supporting documents. What you'll learn as you learn more and more about compliance is what's most important is that the tenant was qualified when they moved into their unit, even if they're not a first-year tenant. If you say you've had a unit qualified for 5 years and the original tenant moves out, and then you move a tenant in who wasn't qualified, who you've made a mistake or for some reason just did not qualify them for the program, that unit falls out of compliance and stops producing a tax credit. And it doesn't start producing a credit again until you get that unqualified tenant out and you get a qualified tenant into that unit. So those initial tenant income certifications are critical. And the IRS will also look at the recent recertification activity to make sure you are meeting whatever are the recertification requirements for your particular property. They also are required, we said, to inspect 20% of your units, and whatever units they inspect, those are the tenant files they are supposed to review. They're supposed to match those. And most of the time, they use HUD's Uniform Physical Condition Standards that HUD established for Project-Based Section 8 and the Public Housing Program. But once you get into this program, you definitely want to become familiar with how it is your state agency does their physical inspections, what protocol they follow, because you want your units to be physically ready for inspection. Something to note, that most of the non-compliance, not most I shouldn't say, but the majority, over 50% of the non-compliance that is found in this program that causes a loss or recapture of credits is because of a non-compliance on the physical condition side of things, not the administrative side. And they are particularly harsh on the physical condition side because they are determined that these are not going to become slum-type properties. And so they have instructed the state housing finance agencies, the IRS has, to be stern and strict with the way they implement their physical inspections within this program. Now, I have a question here. Are these files also reviewed by an auditor? If so, what type of auditor qualifications should an owner look for? That's an excellent question. What often happens is the tenant files, particularly the first-year tenant files, often, well, first of all, the first-year tenant files, you'll complete them. You might have somebody review them for you, and it's very common in this program, much more common than it is in HUD's programs, just because the stakes are higher, because of the investors and the investors holding back their money if the credits aren't produced as projected. And so it's very common for management companies or owners to have somebody review, in particular, those first-year files, so that they know that they are done correctly. And they will also be reviewed by the asset management representative for the investor, either from the syndicator, they have their own asset management department, and they do file reviews, or if it's a direct investment, like just a bank that's investing, they'll hire somebody to do asset management for them. And the investors, they just don't write say if they're going to put in $1 million, they just don't write $1 million check to the developer. That $1 million is broken up into, say, 4 payments. And the final payment is not forwarded to the developer until the owners of the investor's representative, the asset management people, have reviewed your first-year tenant files, because they want to make sure that those credits were really turned on in year 1, because no unit produces a credit until you first occupied it with a qualified resident. So the investor will not put the final bit of their money into your project until they know for sure that all of those units started producing credits during year 1 and that they didn't become 2/3 rule units because you made mistakes in how you qualified any of your residents. Now, when it comes to qualifications, there are certainly a group of well-regarded firms in this industry that do file reviews. And if anybody is interested in receiving information on who to hire, who I recommend, or who's out there so you can do, price comparisons, I'd be happy to share that information with you. And certainly if you're new to this business, the tax credit business, you'll want that. It's well worth the money because of all the money and headache you'll save yourself. And often when you're new to this business, your investor representative will require you to have a consultant that helps you with the tenant files because they just want to be sure that they are done correctly. Okay, Liz, it seems like there is no give or forgiveness if there is an issue of noncompliance. Is there ever some time frame or forgiveness or correction in the case of noncompliance? Well, that's where we're going next. When the State Housing Finance Agency, when they issue, it's called an 8823 form. An 8823 form is the bad form. That's the form you never want to see because that's how they document you being out of compliance. And when they find an incidence of noncompliance, they give you a correction period usually between 30 to 90 days based on the type of noncompliance it is. At the end of that correction period, the Housing Finance Agency has to submit the 8823 form to the IRS. And even if the noncompliance has been corrected, they still have to report it to the IRS, but they note on the form that the noncompliance has been corrected. So if, for example, you move somebody into a unit that was not qualified, and the state finds that when they do your review, they give you a correction period. You somehow figure out how you can get the bad tenant out, get a good tenant in, and so you start producing credits again, but you've still lost those credits for the period of time that unit was out of compliance. So that's, again, why in this industry people spend more money on file reviews and audits than you do in other programs, because the stakes are just higher. Now, something else I want to point out to you on the positive side. The IRS does reward responsible ownership. And what the IRS says is that if an owner has an incidence of noncompliance, but they find it and fix it before they receive notification that the State Housing Finance Agency is coming out to do a review, then that noncompliance is not to be reported to the IRS. So they're saying for those of you who are responsible, who you find your own mistakes and you fix them without anybody hassling you into doing it, then they don't want to hear about it, because they need to spend their time on the owners who really don't care about maintaining compliance. So you want to take that to heart, finding your own mistakes and fixing them on your own, and that can save you a whole lot of hassle and lost credits. Oops, I'm sorry. Hello? Shantaria, can you still hear me?
Yes, Liz, we can hear you.
Okay, I hit the wrong button, and I cannot see, for some reason. I got to pull back in, hit the link again. I apologize.
No problem. Let me wait for you to come in.
Okay. Does anybody want to ask any questions while I'm doing this? I'm happy to field questions while I'm getting myself back in order here. I'm so sorry.
Just let me know when you're back to the link, Liz.
Okay, I'm back to the link. I'm typing in my name. Okay, I don't need to call in again. Or maybe I do.
No, you don't need to call in again. We can hear you fine. I am just waiting for you to enter the room so that I can promote you up.
I'm in the room. I can see the slideshow.
Okay, let's see. It's not allowing me to promote you, but if you want to go ahead and continue, Liz, I can just advance the slides for you until the system allows me to push you up.
Okay, I'm so sorry about this. Is everybody else hearing that echo?
What's happening, Liz? It sounds like your speakers are on.
I'm hearing an echo. I just want to make sure other people aren't hearing it.
I do hear the echo, Liz. Can you turn off your computer speakers since your call dialed in over the phone?
Okay, will do. Okay, I'm muted. My computer is muted.
Okay, you sound much better now, and so you should have control over the presentation now.
Okay. All right, terrific. Sorry, everybody. Okay, somebody else was hearing the echo. Let me know if you still hear the echo. Okay?
Nope, you sound good.
Okay, great. All right, so you've got this correction period. Always take advantage of this correction period, and always take advantage of that opportunity to correct your own mistakes in time to avoid any notification going to the IRS. All right, qualifying an applicant. We've got another question. Do HFAs review rural projects differently than urban projects when it comes to compliance. They have some, they have the same basic rules they have to follow with regards to how often they have to come out. Now, they do some coordination with rural housing services. If any of you, if you got 515s or 535s or whatever kind of RD projects you might have that you might put tax credits on them. And I know, for example, they coordinate with their inspections to avoid doing double inspections. But they still do have to meet the same requirements. Now, at really small projects, I know sometimes 20% is almost all of the units at a small or it's a 20% might, excuse me, let me put it this way, 20% of the units might only be one or two files. So they might decide to review all the tenant files at a really small project. Also, sometimes for small projects, instead of coming out to do file reviews, they might have you submit the paperwork electronically, and so that they can do what they call desk audits, because sometimes the state agencies are understaffed because their portfolios keep growing with regards to the number of projects they need to monitor, but their staff is not growing at the same rate at all. And so sometimes they can't afford the time to go out to visit one very small project in a very rural part of the state, if that's the only project in that part of the state that needs to be monitored at that time. So they might have you submit electronically so they can do desk audits with regards to your file reviews. But they have the same basic requirements that they have to meet as if they were urban projects. All right, qualifying an applicant. For the tax credit program, there are two eligibility tests an applicant must pass to qualify. Their income must not exceed their applicable tax credit income limit, and they must be in compliance with the tax credit full-time student rules. The tax credit income limits. Their gross annual income must be at or below the appropriate income limit, and we said earlier that the income limit that must be used is established in the owner's minimum set-aside. If you committed to the 20 at 50 minimum set-aside, your federal income limit is 50% of the AMI. If you committed to the 40 at 60 minimum set-aside, then your income limit is 60% of the AMI. The Housing and Economic Recovery Act, which I would guess some of you know a whole lot about, made a bunch of changes to a variety of housing programs. And for the Low-Income Housing Tax Credit Program, they established a different system for how we apply our tax credit income limits. Beginning in 2009, HUD began issuing income limits separate specifically for tax credit projects. Before then, we just used those that we generally refer to as the Section 8 income limits. And in HUD speak, a tax credit project is an MTSP, a multifamily tax subsidy project. So they issue what they call the MTSP income limits the same day every year as they issue the Section 8 income limits. And so point I want to make sure you understand at this point about your income limits is you want to make sure you're using your tax credit income limits to qualify people for tax credit units, not the Section 8 income limits. In addition to the income limit, you have the full-time student rule, the second test, to qualify an applicant. The general rule for tax credit purposes says that households comprised entirely of full-time students are generally ineligible for the tax credit program. And a full-time student is somebody who attends school with full-time status for at least 5 months out of a calendar year, and those 5 months need not be consecutive. And we said you attend with full-time status. That status is verified with the learning institution that they attend, whether they're attending as a full-time or a part-time student. An unborn child is included when qualifying a household under the student rule, and school-aged children are automatically considered full-time students. You don't have to verify that. Now, there may be a form that your state agency requires you to use to document student status for purposes of applying this rule. And if everyone in a household, hello?
We hear you, Liz.
Okay. For some reason, I lost. There I am again. I don't know what I didn't think I hit anything, but I'm back at the full-time student rule again.
Okay.
And okay, I lost the slideshow there for a minute for some reason. There we are. I'm back. Okay. So if everyone in a household is a full-time student, they are ineligible unless the manager documents in writing in their tenant file why they should be considered eligible. Because when the state agency or the asset manager for your investor reviews a file where everybody's a full-time student, that's a red flag file. They are considered ineligible unless you show them why they should be considered eligible. Now, a household comprised entirely of full-time households may be eligible if all household members are married and are at least eligible to file a joint tax return. They can be eligible if there is a single parent with at least one child, and this is the one we see most often, none of whom are dependents on another person's most recent tax return, except for the return of the child's other parent. They can be eligible if at least one household member is a welfare recipient, and that's not a disability or food stamps. It means TANF or PA or whatever you refer to the general welfare program to be in your jurisdiction. They can qualify if at least one household member participates in a federal, state, or local job training program like those funded through the Workforce Investment Act, or the most recent addition, they can qualify if at least one household member was a foster child during their lifetime. And currently there's no age limitation on that. I'll add, currently in Congress, there is a bill that may or may not make it through where they would add 2 more exceptions for people who have been recently homeless and for veterans who have been recently homeless. Those aren't in play yet. I imagine someday they will be, because I think they're the kind that will generally get passed, but we'll watch and listen for those. For now, these are the 5 exceptions for the full-time student rule. Okay, did I see another one? Let's see. Nope. No, all right, yeah, here it is. What's the reasoning behind the full-time student rule with tax credits? Good question. Two issues. First of all, they did not want this affordable housing resource used by a bunch of 18, 19-year-olds who look poor based on their own income, but who are they really living off of mom and dad? Secondly, there is written right into Section 42 of the tax code, which is where this program is based. It says that there can be no transient housing under this program. So you can't use tax credits for college dormitories, and that was the reasoning for the original full-time student rule. And what has happened over the years, because it was stricter earlier than it is now, but what has happened over the years is people raised their hands and said, gee, there are these other households that we think we should want to house in this program, even if they're all going to school, such as the single parent and children household. And so over years, they've added exceptions to this rule, and that's why they're looking at the 2 additional exceptions now for veterans that have been recently homeless and other people who have been recently homeless. But that's the big issue, is no transient housing. That's the big issue for the full-time student rule. All righty, when it comes to calculating annual income, in this program, in a variety of ways, we mimic HUD's rules for the project-based Section 8 program, and you find the rules for that program in the 4350.3 handbook. And so we looked at Chapter 5 of the 4350 to tell us how to calculate gross annual income. We also looked at the 4350 to tell us how we count how many people are in a household when picking the right income limit for a household. So we use those rules to determine if it's a 4-person household or a 3-person household, etc. Now, when you verify information, income income, for example, full-time student status. We follow the rules for project-based Section 8, except that in the tax credit program at this point, we are not allowed to use information obtained through EIV, the Electronic Income Verification System, which is required in the Section 8 and public housing programs. So in the tax credit program, since we can't use EIV, we do third-party verifications. That is our gold standard. If a third party if there isn't a third party or no responsive third party, then we do a review of documents, such as when we make a copy of 6 recent current consecutive pay stubs to document somebody's income. And when neither of those, the first 2 options are not available for one reason or another, we take a tenant certification, where a tenant signs a statement, usually notarized, that something is true about them. We use those sparingly in this program, but sometimes they are our only option. For example, if you have an adult in a household who claims to not be working, there's no way you can know for sure that they are not working. There's no computer program you can run that will tell you that they're not making money under the table. So we have them sign a zero income statement so that they are on record every year stating that they are not bringing any income into their household. And if they're telling the truth, hey, that's terrific. If they happen to not be telling the truth, then you have them on record as telling you that they weren't bringing any income into the household. And so if later on you have to proceed against them in court to put them out of their unit, you have them on record telling you that they brought no income into their family. Information has to be good within 120 days. Information cannot be more than 120 days old on the effective date of what we call a TIC, a tenant income certification. And anybody who comes to review your files, be it the State Housing Finance Agency or the asset management team for your investor, that's always one of the big things they're clued in to look for, to make sure the information you were using was fresh when you documented somebody's qualifications for the tax credit program. The IRS does not provide any forms or require any specific forms that we use on the compliance side, but sometimes your State Housing Finance Agency does, and they will have a compliance website or a homepage for compliance on the state agency's website, where they may have a full compliance manual in addition to forms that they either recommend or require that you use. The unit itself also has to be qualified for the tax credit program, and the biggest issue with regards to making sure the unit is eligible is to making sure you're not charging more than the maximum allowable rent. In this program, the maximum rent we calculate by formula is the gross rent, and we subtract from it a utility allowance to get the tenant rent you can directly charge the tenant. And in this particular program, the maximum rent is calculated not based on the family's direct income, but it's calculated per unit size based on the project's income limits. So the income limit you commit to when you commit to the minimum set-aside also sets the rent structure for your project. And what we're told to do by the IRS is to pretend a household size of 1.5 persons per bedroom, or 1 person for a studio or an efficiency apartment. And the maximum allowable rent for a tax credit unit is 30% of the income limit for that pretend household size. So here, we'll go several slides. You'll see there's the formulas for how you calculate the maximum rent for all the different unit sizes you might have. Alrighty, here's an example of how the calculation is done you can look at. Here's for a 1-bedroom, where you have to average the 1- and 2-person income limits, because you're talking about using the income limit from 1.5 persons. In the second example, we're calculating the rent for a 2-bedroom apartment. So 2 times 1.5 persons is 3 persons. So we can just use the income limit for 3 persons to calculate the rent for our 2-bedroom apartments. You have to rent to people on the voucher program. They are considered a protected class. So if somebody comes to apply at a tax credit property and they have a housing choice voucher, you still have to qualify them for the tax credit program. They have to be below the tax credit income limit, and they have to be in compliance with the tax credit student rule. But you cannot use the reason that they have a voucher, as the fact that they have a voucher, as the reason why you will not rent to them. One good thing about renting to people, an excellent thing really, to renting to people on any kind of Section 8, be it tenant-based or project-based, is that that is the only time, when you rent to somebody on rental subsidy, that is the only time you can collect more than the tax credit rent for the unit and get the tax credit for the unit. So when you have a tenant who's on Section 8, you qualify them for the tax credit program, and then the Section 8 program completely governs their rent. And if that means you get some extra rent out of the unit, that's just fine with the IRS. Now, the last bit here is all about maintaining compliance. We won't have time to go through it. I thought we might have too much material, but I still wanted to provide it for you in the slideshow so that you could review it yourself, and that way it give you an idea of what you would be looking at if you were going to be managing a tax credit property long term, and the kinds of rules you need to make sure you understand when you take on managing a tax credit project. Maintaining compliance is particularly difficult if you're looking at mixed income projects. 100% tax credit projects are always simpler to manage. So you want to keep that in mind as you're making your business decisions. Now, this last slide here is a good number of the ways you can contact me. You're welcome to contact me if you have any questions about anything we talked about today. Best way to reach me is by email. So my email is liz@lizbramletconsulting.com. Please feel free to use that if you have any other thoughts or questions as you're planning what you want to do with the future of your organizations. Please contact me. I'd love to be of help. Also, you'll be getting an email from my firm where we're going to sign you up for our list service, where on a regular basis we share information on the industry, and we do marketing. I want to share with you for the courses that we teach. You'll get a letter, but in order to actually start getting on our list service, there's a link you have to click on to say, yes, we want to receive information from Liz Bramlet Consulting. If you don't want to get information from us, which is, of course, you're right, just don't click on that link and you won't hear from us again. But if you are interested in getting information from us, click on that link and you'll automatically be put on our list service and you'll start receiving information from us. Are there any other questions anybody would like to ask?
Liz, do we want to go ahead and open up the phone line so that folks can ask questions verbally if they don't want to?
Of course, of course.
Okay. So we're actually going to unmute all the phone lines. We would ask that folks that are not interested in asking questions verbally mute your lines locally so that we don't get the feedback on the audio, so that we're able to better hear the questions that are being asked and the answers that are being given. So at this point, I am going to go ahead and unmute all the lines. All right, so do we have any verbal questions out there for Liz? We've had quite a few come in via the chat, and so are there any remaining questions out there? All right, then, having heard no verbal questions come through and not seeing anyone typing in the chat box, just want to do a quick reminder before we wrap up. The recording and the materials will be available on HAC's website, www.ruralhome.org. Also, please be on the lookout for an email containing the link to your certificate of participation for this webinar. Let's see. I want to, at this time, thank Elizabeth for the wealth of information that she's provided during today's webinar, and also thank you to all of the participants for being so patient with us as we addressed our technical issues during the webinar today. And so if there are no further questions or comments from Liz, I want to say thank you for participating in today's webinar and have a good rest of your afternoon. Well, wait, Liz, we have one question. Oh, thank you. Thank you so much, Kathleen. Thank you for joining us.
Oh, yeah.
So with that said, everyone have a nice rest of your afternoon.
Bye-bye.